All right, welcome everybody. It's good to have you here. We're excited to do this year-end tax planning webinar for restaurant owners. Um, by way of introduction, my name is Michael McCluskey, and I will be your presenter for today. We do have a back office team at Haney that's going to help host, and we're appreciative of their support and help, and excited to talk about these different topics. So my intention for today is I do want to introduce myself a little bit. I do want to introduce Haney and Company. And then I want to start talking about some year-end tax strategies that could work for you. So with that being said, let's proceed. And I want to start talking a little bit about Haney, just to give you some context. So Haney and Company is a CPA firm that's been around since 1960. And I've been with the firm my whole career. So I've spent a lot of time on the tax side. I've also helped on the accounting services side. And really our focus is small and medium to sized businesses. Now, with that being said, we do tax projects for individuals, businesses, nonprofits. We really run the gamut. And one of our specialty areas is franchisees, specifically those within the Denny's franchisee community. And so even though that's kind of where my specialties have lied, the firm big picture does other things. So the firm also does auditing and consulting, wealth management, as I mentioned, accounting services, and sometimes even valuation work. So we have all of those things under the Haney umbrella. For many of you, you may have remembered one of my former colleagues, Robert Duskin. His practice actually merged into Haney and Company back in 2019. And one of his visions for the future was that he could merge into a firm that would be able to offer all of these supplemental services to the Denny's franchisee clients so that, again, if they did need evaluation, they knew where to turn. If they did need accounting support, they knew where to turn. If they did need support with any type of consulting, there was an opportunity there for that. And so one of our goals is to help realize his vision to be a one-stop shop for the professionals and franchisees within the Denny's community. So from a firm perspective, we are in 5 different states and we're about 450 people strong. That makes us a top 100 firm as it relates to CPA firms in the United States in terms of our revenue, in terms of our size. And so again, one of our mantras is that even though we can provide big firm services, we also provide that personalized touch that you would get at a small firm. And so that's a little bit about Haney and a little bit about me. So again, my focus has been in the tax arena and the accounting arena, focusing on tax preparation, planning, strategy, consulting for corporations, S corporations, individuals, really running the gamut. So we really have a great team here at Haney, and we're excited that you're here to learn a little bit more about this. So with that being said, anytime we talk about tax planning, we have to talk about the macro considerations. So the big thing that we have on the horizon right now is we have the presidential election. So the 2024 presidential election really will shape the landscape for what tax law will be going forward. And that's primarily, it's for 2 reasons primarily. The first reason is that whoever becomes the president will have influence on what tax law will be. And the second primary reason is that the tax cuts that were implemented through President Donald Trump back in 2017 are set to expire in 2025. And so the question becomes, okay, what does that mean? So what it means, simply stated, is that everything that was implemented in 2017 is essentially going to go away unless Congress does something to extend that. So there's a couple of different options that exist. Congress could extend it in full. Congress could not extend any of it. Or they could say, we're going to extend this and we're going to extend that, but we're not going to extend anything else. So we don't know. But one thing that we do know is that typically the folks in the Republican Party would prefer to extend these provisions. And we also know that the folks in the Democratic Party have a different opinion about how that should be. So we've got a major macro consideration of what is going to happen with the presidential election. So at this point in time, because we don't know, it's still very early in the process, I thought it would be helpful to at least talk about some of the different ideas that are out there, some of the different considerations that the candidates are putting together. Now, again, just because this is what they're communicating doesn't mean that this is what would be, but it should give some baseline for what this could mean to you. So from your perspective, if you're a restaurant owner or you work in a restaurant and you're in a situation where maybe you're ready to exit the business. Maybe you think within 2, 3, 4 years, it's time to exit the business. One thing that we'll talk about with respect to this is if you're thinking about exiting the business in 2 or 3 or 4 years, if the Democrat Party becomes the majority party in Congress as a result of the 2024 election, it is quite certain that tax rates will go up. And tax rates will quite possibly go up on capital gains, which could affect that sale of the business, or in other words, it would affect the money that you're able to keep in your pocket as a result of the sale of that business. Now, that's not necessarily what will be, but it's what could be. So with that being said, let's talk through some of the different ideas out here, and then we'll narrow this down and make it more specific to what you may be dealing with as a restaurant owner or a restaurant professional. So with respect to President Biden, one of the things that he's communicated is that no matter what, he would like to raise taxes on individuals that make more than $400,000. And so one of the reasons he's willing to put that out there is because generally speaking, within our population, there are not many people that make more than $400,000. And so it's a scenario where you can communicate, hey, we want to increase tax revenue. We want to provide these services to our people. And at the same time, it's not massively unpopular because most people say, well, that doesn't affect me. However, if you're an individual who will be making more than $400,000, or you may have a year in the next 3 or 4 years where you might eclipse that amount of income, that's very important to know as it relates to your business and it relates to tax planning. Because again, you're trying to pay the least amount of tax. Nikki Haley's got a couple of different ideas. She wants to remove the 18-cent gallon per gas tax. She's also interested in lowering just the rates for working families. It's pretty bland. It's pretty vague at this point. So there's not much to think about there. Ron DeSantis, you can see he wants to extend the provisions. He also indicates he wants to eliminate the IRS, along with Vivek Ramaswamy. So Ramaswamy also proposes a flat tax, and Chris Christie, they want to keep some of those provisions from the Donald Trump era in there. So what you can kind of see from this big picture is you can see the Democrat Party, for the most part, is going to plan to raise taxes on higher income individuals. That would be part of the agenda if they could push it through. Now, what does that look like? We don't exactly know, but we know $400,000 is an amount of income that seems to be acceptable to the Democrat Party as a way to increase taxes. And we know that the Republican Party, for the most part, they want to extend the Trump tax cuts. And some of them have even, more extreme views, like eliminate the IRS or, do a flat tax. Those things are just 100% non-starters. They're not going to happen. But it's something that, they're communicating during these primaries so that, they can build a base, that they can show that they're, strong for business and working class professionals, and that they value conservative principles. So that's the message they're communicating. If they were to become president, it becomes much more difficult to do something like that. But big picture, this is important. So of course, as we're looking at the presidential election, it's more than just taxes, right? We're worried about other things too. There's many issues out there and many things that we're concerned about. But this is an important issue to keep an eye on and be mindful of, especially as it relates to your business. So with that being said, I won't go into any further detail on that, but be mindful of that because each of these candidates is putting together a plan, they're putting together ideas, and that will affect all of us to one degree or another. Okay, so I will say this, as we get into the more specific items here for tax planning, it's really important to note that anytime we talk about tax planning or tax strategy, we're really in a forum like this for a general audience. It's really important to note that this is really sort of what I would consider the appetizer, right? The design of this webinar is to give you some ideas. It's there to put some considerations on your radar. It's designed to give you insight on what you could do as a business owner. But with that being said, it's not a substitute for speaking with your tax professional and seeing if the specifics of the law apply to the intricacies of your business, because each taxpayer situation, and I will refer to our audience here as taxpayers because that's how the IRS thinks of you. They think of you as a taxpayer. Each taxpayer has a unique situation, and what's right for one taxpayer may not be right for another taxpayer. And that may seem a little bit obvious, but sometimes if you've got a peer that has 4 restaurants and you have 4 restaurants, you may think that the plan for your peer could work exactly for you the same way it works for them. And that may not be the case. So I want to put ideas out there, not as specific tax advice for you, but just ideas that you can consider as an appetizer. And if you're interested in the course of this, that you want to talk further, I would welcome you to speak with your tax professional. If you're interested in talking with us at Haney Company, we'd love to have that conversation too, and do some full extensive tax planning as it relates to these topics. So again, I want to put that out there just as an expectation so you understand the needs and you understand how this can apply to you. And my hope is by the time the webinar is over that you essentially have left here with 2 or 3 different insights that can be useful to you going forward. So with that being said, one of the biggest things that Congress has pushed through is they've pushed through with what they call favorable expensing on equipment and vehicle purchases. And the reason this is important is because really what they're saying is anytime a business owner purchases a piece of equipment, personal property, whether it's a car, an oven, whatever it is, they want to try to find ways to make that easier for you because that's a really easy way to stimulate the economy. So, President Trump put this together as part of his package back in 2017, and they basically said any equipment you buy is going to be able to be written off 100%. And that was great for a lot of people. They said, that's great. I'll buy an oven. I'll buy some new countertops. I'll buy these new fixtures, and we'll just be able to deduct them all in that first year. And so, that stimulates the economy. That gets purchasing power moving, and it also reduces your tax bill, of course. And so that was a very popular thing. However, this is one of those provisions that starts to phase out. And so, as you can see here on the graph, we started with 80%. Or I should say we started with 100% through 2022. Now in 2023, the bonus depreciation phase out is 80%. And going forward, it's going to go down to 60, 40, 20, and then 0% all the way into 2027. That is the phase out plan. So you can see that becomes increasingly less attractive over time. And that's one of the things that had to be included in that law to get it passed initially. So this has been really a go-to mechanism for a lot of business owners. And you've probably heard these conversations a million times. It's the end of the year. Should I buy a car? Should I buy a truck? Should I buy, again, the new oven, the new dishwasher, the new whatever? Should I buy this and be able to depreciate it to reduce my tax bill? So here's my short answer to this. My short answer to this is that, generally speaking, if you need the piece of equipment, if you expect to need the piece of equipment within the next 3 to 6 months, it's something that's worth considering. Because the good news is that even though you may not need the equipment right at this second, you need it in the next, let's say, 60 days or 90 days. If you can at least place that equipment in service so you're actually using it, as long as it's placed in service by the end of the year, then that's a deduction that's created on your tax return. And that's good, right? From the perspective of getting the deduction, from the perspective of reducing the tax, that's a good thing. And so, but, the alternative is, hey, last year my income was really high. I bought a truck because, my income was high and I kind of needed a truck. Now we're in 2023 December. It's not uncommon for someone to say, hey, should I buy another truck? And the answer is no, you don't need another truck. You don't want to just buy a truck to get a tax deduction. But if you need a truck, then it can be something worth considering. So there's economic factors that play into this, but we certainly don't want the tax considerations to essentially drive the whole conversation. It drives part of it, but it doesn't drive all of it. So as I'm talking about this, the other thing that we also need to consider is what's your income going to look like next year? Is your income going to be bigger next year, or is it going to be smaller next year? And so one of the simplest ways to really consider this would be, okay, if you've had a really good income year this year, but next year is going to be smaller, then yeah, let's see if there is a way to shift more deductions into this year, because we know 2024 is going to be a lighter year for whatever reason. So just as an example, let's imagine you're selling a unit or selling 2 units in 2023, but you're going to keep your remaining units in 2024, and your income will be a little bit more stable. So that would be a great opportunity to say, look, big picture, we know that we're going to have higher tax in 2023. If there's equipment we need to purchase, if there's a vehicle we need to upgrade, if there's any types of improvements that we need to do, this would be an optimum time to do that because we're getting the best bang for our buck, right? We're probably going to get taxed at the highest rate, and taking this deduction now will allow us to really reduce that tax. So again, you've got to look at all of these things in comparison. We look at 2 years together at minimum, and then we consider, okay, what type of benefit would this have if we take this into consideration? So I will say this too, we do have a Q&A. So if any of you do have questions and want to put those into the Q&A, I can work to answer those. If they're very specific questions that are related to you or your business, what I'd prefer to do is just get back with you on that so it can be tailored, so the response can be tailored to your specific needs and can be more specific. But if you have other questions, whether it's about tax rates, whether it's about specific equipment or anything like that that you want to talk through, put it in the Q&A and we can at least have that as a consideration. Okay, so with that being said, think about equipment and vehicle purchases as you're in in this last month here. So with respect to business losses, there's a lot of scenarios out there where folks have business losses that are just being suspended or not fully usable. So if you've got a business loss that's out there, whether it's a net operating loss, whether it's a capital loss, the first question is really, can these losses be used? And then the next question is, if they can't be used, when do they expire? So here's what I wanted to communicate on this. Prior to the tax cuts that were implemented through President Trump, net operating losses, which were essentially scenarios where a taxpayer had losses in excess of their income, so they had just excess losses. The typical answer for those was those losses can be carried back 2 years, then be carried back 2 prior tax years, and then they would be carried forward another 20 years. Right. And so there was essentially an expiration date on those. There was a 20-year expiration date. New law came into play and Congress limited net operating losses, but they also said these losses will now no longer expire. So there's taxpayers out there, business owners out there that have net operating losses that have expiration dates, and they have net operating losses that don't have expiration dates. And so the one thing you don't want to do is you don't want to be in a scenario where you say, holy cow, I've got all these losses that are going to expire and I'm not going to be able to use them. You want to find a way to use those losses. Otherwise, they just go away. And so knowing that there's an expiration date can really facilitate some planning because it allows you to say, okay, I've got X amount of dollars to use as a loss. What can I do to generate additional income in this current year so that I can use that loss and reduce my tax? So again, you get into considerations that may not even involve your restaurant. You get into considerations of how you may deal with other companies that you own, other investments that you may own, other types of property that you may have, or scenarios where you can essentially manage the income to a degree to which you can utilize those losses. And so again, part of a comprehensive tax plan is going to say, here's the type of income that I expect on a regular basis. Here's the type of losses I have to work with, or the deductions that I have to work with. How do I get those to come together in such a way that I can utilize those and reduce my tax? So just a couple of things to be aware of. I mentioned net operating losses. Those are business losses that occur essentially in excess of your income. There's also capital losses, which are losses on the sale of investment property. If you happen to have those can only be offset against capital gains. So for example, if you bought, Apple stock and, you're selling that at a gain because it went up in value. If you've got another stock that lost just a ton of money, let's imagine it's, whatever, Nicholas stock, whatever it is, let's imagine that's lost a bunch of money. Those two can offset, but they can only offset against your ordinary income to the extent of $3,000. So you've got to be mindful of those two. There's also real estate losses that can be suspended and can be sitting there waiting to be used. So you've got to be sensitive to those. And those are interesting too, because if you own any of the buildings in which your restaurants exist. So for example, if you own the land and the building and you're doing some type of rental arrangement within your own companies. So for example, you own the operations, you also own the real estate. If the operations is paying rent over to the building that you own, technically that falls under what the IRS calls a self-rental arrangement. And it's a very odd arrangement because the income from that is considered to be ordinary non-passive income, but the losses are considered to be passive losses. So it creates a nightmare for trying to figure out how to match those up. But it's important to know that they're there. So again, I recognize that in this economy, there are certain folks that are doing very well with their franchises, but I know that almost every franchisee would say things are very tight with inflation, labor costs, and food costs. And there are scenarios there where losses are significant. And so if you do have significant losses, it's at least advisable to understand, number one, what are the nature of them? Are they net operating losses? Are they suspended real estate passive losses? Are they capital losses? What's the nature of them? And then number two, do any of them expire? Then number three, how do we use them? What are the options we have to actually use those? Okay, so this next one's a really important one, estimated tax payments. So as you know, Denny's franchisees operate in many different types of legal structures. Some are sole proprietors, some are multi-member LLCs, some are S corporations, some are C corporations. All of them have a slightly different scenario in the way that they do things. But regardless of that, the IRS's system is what we call a pay-as-you-go system, where there's an expectation and a requirement that you pay tax as you're making money. So as a Denny's franchisee or as a restaurant operator, professional, this can be very difficult to do if you're not getting a standard paycheck, or if your paycheck is a very small amount of your overall net income. And so the estimated tax payments are really due quarterly throughout the year, assuming you earn income evenly throughout the year. And so basically what the IRS is saying is, look, even if let's just imagine a really simple scenario. Let's just imagine you're a sole proprietor, you've got one restaurant, and you don't have a corporate entity. It's really just a sole proprietorship. As a sole proprietor, you don't take a paycheck. And whatever income you derive from your restaurant is going to be taxed on your personal tax return. And that's where you're going to pay your tax, both federal and state. So in a scenario like that, if you haven't paid, assuming you have income, if you haven't paid any income, or I should say any tax, estimated tax into the government, then there will be some penalties on that. Now, there are exceptions to everything. As an example, there's an exception if you paid in 100% of your prior year tax. There's an exception if your tax overall is under $1,000. There's all these exceptions, right? And so that's why this is meant to be the appetizer for the main course later on, which is the full tax planning. But the reality is this: you're supposed to be paying taxes in. If you're making money and you haven't paid taxes in, then there will be some penalty on that. And that's what they call an underpayment penalty, which is based off of IRS interest rates. And so it hasn't been a really big deal for the past number of years because interest rates have been so low. So when the IRS was penalizing people, they were saying, okay, the penalty is going to be essentially 3% of whatever the tax that you owe is. And so again, it's not fun to pay that amount, but it's not a huge amount. It was only 3%. Interest rates have changed. As interest rates have gone up, so has the interest that's assessed on these penalties. And so now instead of being 3%, we're talking about 8%. And so 8% becomes much more significant, much more unpleasant to have to pay. So with that being said, when we talk about tax planning, talking about estimated tax payments is not the sexiest thing to talk about, right? It's not the sophisticated tax planning maneuvers that get everybody excited. But a part of tax planning is the minimizing, reduction, or complete elimination of any penalties, right? And there are reasons why sometimes it's okay to pay a penalty. It could depend on how you want to use the cash for another venture in the meantime, et cetera. But it's something that you at least have to be aware of. The last thing that we want to do as tax professionals is go to you when your tax return is done and say, surprise, you owe a tax. And also, you owe an additional 8% because no estimated payments were paid during the year. So, again, there's ways to kind of work around that and strategize with that, especially if you haven't made your money evenly throughout the year. But again, one of the least sexy planning options is one of the most effective, and reducing penalties is something that everyone should be able to work through. So I will say this, and I will say this in conclusion here: it's not reasonable to think that everyone's going to make income evenly throughout the year, right? So this estimated payment schedule really assumes that. It assumes that you earned 1/4 by April, 1/4 by June, et cetera, et cetera. And that's not the case. So when you have a scenario where maybe you've earned more income in the latter part of the year, then there's a way from a tax professional perspective to essentially utilize that to say, look, they made more money at the end of the year. The estimated payments should be bigger at the end of the year relative to the beginning of the year. Therefore, the penalty should be reduced or completely mitigated. So again, another strategy that's sitting out there and something you should be aware of. Now, some of you come from states where there's no state income tax. Others of you come from states that have significant state income taxes. Each state has its own rules about this. Utah, for example, just requires that your full amount of tax is due by April 15th each year. Other states like Arizona, the state in which I'm in, requires that you do make estimated payments if you make a certain amount of income each year. And again, each state is a little different. And so it's important to be mindful of the state implications too, because that does have an effect on you, of course. Okay, so this is the pass-through entity tax is a relatively new provision that states are putting together as a way to work around what the IRS calls the state and local tax cap. And so let me explain. When the Trump tax cuts came into play, they gave a bunch of deductions and they took away a bunch of deductions. That's just how it works. So it gave to some, it took away from others. One of the things that they took was the ability for taxpayers like you and me to deduct unlimited amounts of property taxes and state income taxes on their personal tax return. So historically, if you were a high income taxpayer and you were, let's just say you were in the state of New York and you made a lot of money and you paid a lot of tax to New York because of that, let's imagine, just to keep it simple and use some numbers here. Let's imagine that in the state of New York, you ended up having a tax bill of $100,000 because that's what you owed. You made a lot of money. New York has high rates. You paid $100,000 to New York. The IRS would let you deduct $100,000 on your federal tax return as an itemized deduction. Now, again, it didn't matter if that number was 100,000. It didn't matter if it was 50,000. It didn't matter if it was a million. They would let you deduct that full amount. That was a thing. And many of you probably remember that. And that was also, in addition, you could also deduct the property taxes that you paid on your home. Again, if you're in a high tax state like Illinois, New York, California, New Jersey, whatever, then you probably paid significant income tax, or I should say real estate taxes on your property. And you were also able to deduct those. So that was good. However, with the Trump tax cuts, they basically said, we are limiting your ability to deduct those taxes, state and local income taxes, which includes real estate taxes. We are limiting that to $10,000. So that was a really, really big hit to folks in high income states or folks that made significant income. They were really, really hit by that. And so for many years, the states thought about different ways they could do this. This is because the state is a little bit at odds with the IRS. They're saying, we want our taxpayers to be able to take this deduction. We don't think it's fair. We're the ones taxing them, and we want to give them some relief. And so they were looking for different ways to do this. And one of the things that's become very prominent and popular is something called the pass-through entity tax. And so the way that this works is this really only works for someone that has a company, specifically a partnership or an S corp, and it works in a way that you are able to shift the tax burden, the income tax burden from you specifically over to your company, and allow the company to make the payment for the taxes, so that the company gets a deduction, And then as that passes through to you, you were able to claim a credit. So again, it's complicated. It's taken a long time for people to really get their heads wrapped around this. Let me just kind of walk through this example on the slide, and this might be a little bit helpful here. So when you don't have the pass-through entity tax, you can see here on the slide in the column without the PTE, you can see here that the itemized deduction tax deduction limit is $10,000. So you can see ultimately, as that trickles down, the total tax ends up being around $456,000. When you have the pass-through entity tax, you are still able to utilize that full deduction, right? You can still take that full deduction, in this case of $90,000, right? And so that's able to reduce the income from your business, and therefore it reduces the amount of tax that you have to pay. And again, when it comes time to paying the state, you also get a credit for that. So my recommendation would be this. I know there's a lot to unpack with that, but my recommendation would be this. If you have a company that's a pass-through entity, like a partnership or an S corporation, the next question is, have you been taking the pass-through entity tax? Have you been utilizing this provision? And the next question would be, does your state, assuming you're not using it, are you not using it because your state doesn't offer it? Or are you not utilizing it because it hasn't been worthwhile to you at this point in time, or something you haven't been made aware of? So if it's something that you haven't been made aware of, and it's something that your state does have, then I would recommend looking into this. For the most part, many of the states require that these payments be paid by December 31st. There are some states that require that the payments be paid by April 15th of the following year. However, there are some states, like California, for example, that does require that if you are going to be eligible for this provision, you must have paid some of the payment at least by June of 2023. So unfortunately, if you're in California right now and you're thinking, I still would like to take advantage of this, unfortunately, your time has run out for 2023. It's something you could still do for 2024, but it's not something that you would be able to do for 2023 at this point. So again, this was a workaround to try to mitigate the provision in the Trump tax cuts that limited taxpayers' ability to deduct the full amount of state income taxes paid in New York, or the state of real estate, or the real estate taxes they paid on their property. Okay, charitable donations are always a really good place to talk towards the end of the year. We're in the holiday season. There's a lot of giving, there's a lot of receiving, there's a lot of opportunities to donate, and charitable donations do create a tax deduction for you. So I want to focus on two things as it relates to this. The first one I want to focus on is, number one, you can deduct donations for both cash and non-cash donations. Non-cash donations are relatively straightforward. If you're donating clothing, electronics, furniture to a qualified charity like Goodwill, Salvation Army, whatever it might be, you are able to receive a deduction for the value of that. If you're doing cash donations, again, they have to go to a qualified charity, and you are able to receive a deduction for that. So as it relates to charitable donations, they're always good to do. There are some states that have specific provisions that allow you to maximize more of your benefits by doing specific state charities. But again, that's a state-by-state thing that we could talk about. But for the most part, charitable is always a good thing you can do. However, it's most important if you're really in an event in your life where, again, you're looking to either exit the business or you're dealing with a really large windfall. And so again, I'm only mentioning that because, if you're looking towards having a really large windfall in a current year and saying, okay, maybe I'm exiting the business completely, I'm going to have a large amount of money, and I do want to start to evaluate how I can provide charitable donations and support these organizations that I'm so passionate about. That is a great time to at least start the planning process, because even though you may not know exactly where you want to put that money, you can still utilize something called the donor advised fund, which says, okay, I'm going to park money in a donor advised fund, which is held in a place like Vanguard or Fidelity. And they basically say, by putting the money here in the donor advised fund, you are eligible for the full tax deduction. So you put in $50,000, you've got a $50,000 tax deduction that is available to you that you can use. You do not have to commit to the organization you want that money to ultimately go to, or the organizations. So that money can be dispersed in 2024. It could be dispersed in 2025. You've got time to do that. But what you don't want to do is you don't want to say, well, I'm having a really good income year. It's a monumental event. It's a windfall year, and I should do something, but I don't quite know what to do or how to do it. And so you don't do anything. And the next year, when you're ready to make those donations, your income is significantly lower, and you are not able to really get a significant tax deduction for it. Again, you'll still get some depending on what your income is, but ideally you want to be offsetting your income that's being taxed at the highest rates rather than income that's being taxed in the lower rates. And so if you're in a windfall year, that's a great opportunity to do that. One thing I will mention too is that it isn't uncommon for people to donate appreciated stock. And that's, still a great option. The stock market is a little bit up and down, but for the most part, it's up. If you're looking to create a charitable donation and reduce your tax, and you've got some appreciated stock, that's a great opportunity and a thing to do. So the way that works is essentially you have stock that you've purchased at whatever price you purchased it a long time ago. Let's imagine it's tripled in value, or it's 10 times the value that you paid for it. When you donate that to a charity, your deduction is not your cost. Your deduction is the value. And that's great for you because you didn't have to pay for that value. You just had to wait for that value. So that value appreciated over time. And now you're able to capitalize and really benefit in two ways. Number one, you get a tax deduction. Number two, you support an organization that you're passionate about, and you allow them to take that stock and do what they want with it, whether they hold it, whether they liquidate it and use the cash to service their programs. That's another common thing that should be in every taxpayer's back pocket. The other thing I'll mention briefly is as you get to retirement age, as you get to that age where you have minimum distributions that are required, there is an option to do what's called a qualified charitable distribution. And so that is a distribution where instead of your minimum distribution being paid to you, you elect to have that distribution paid directly to a qualified charity. So again, that's good because it satisfies the minimum distribution requirement. And it's also good because you don't have to pay any tax on it, right? So if you want to donate to an organization, you intend to donate to an organization, you also want to keep your tax low, it's really nice to be able to say to your IRA custodian, go ahead and send that directly over to this charity. And that way you're able to support them and not have to pay any tax on it. That really is a good benefit. It's something you can do each year up to $100,000. And so again, it doesn't mean that you have to do that with all of your minimum distribution, but if you wanted to do it with a portion, you certainly would save some tax. So with that being said, we're going to stop here for just 1 second before we conclude and do a couple of polling questions. So the first polling question is going to pop right up. If you're able to, we'd love to have you respond. All right, this is a polling question about which state are you operating your restaurant business in? Which state are you located in? Like I said, we're here in Arizona, even though we've got offices all over the Mountain West here, but we are here in Arizona. So that's where we are. Okay, let's move on. So talking about charitable donations, let's move on to talk about the sale of a business. This is an important one to talk about too. So when we talk about the sale of a business, the first thing we really need to know is we really need to know what type of business are you, right? Because that determines what you're actually selling. So if you are any business, you really have two things you can sell. Big picture, you've got assets that you can sell, or you have stock. Now, not every business has stock, but those are the two potential things that you have to sell. You've got assets and you've got stock. So the question becomes, okay, what are you and what are you selling? And if I'm selling one or the other, does it matter? And so the answer to that question is it depends. But big picture, when you're when you're selling stock, really what you're selling is you're selling the company in the full capacity of the company. You're selling the assets that are part of that. You're selling the obligations that are part of that. You're selling the debts that are a part of that. And so a stock deal is usually very favorable to the seller, and it would be less favorable to the buyer. Again, not in all instances, but typically that would be the case. And if you're selling assets, you are literally just selling the assets, right? You're splitting up the assets between equipment, furniture, land, building, improvements, inventory, whatever it is you're selling, that is what you are selling. So typically speaking, buyers like that. They like that because when they buy an asset from you, just like we talked about a few slides ago, when they buy an asset from you, they get to depreciate that asset. And they get to depreciate that asset using favorable expensing rates. So they're able to get tax deductions that they want to get. So in theory, if you're looking to sell your business and you have a potential buyer or buyers, in theory, the buyers should be motivated to put together an asset purchase because they want the tax benefits that come from that. So what does that mean for you? It means that you may have the opportunity to negotiate a slightly higher price because they want the assets and they want the tax deductions, and you know that. And so again, that might help you negotiate a slightly higher price that can benefit you and also benefit them. And the flip side of that for you is this: if you sell assets, again, you're selling assets that have probably been depreciated almost completely, again, because of all of these favorable depreciation rules over the past number of years. Your assets probably have an adjusted basis, probably close to zero, meaning you purchased them for, let's say, purchase some furniture for $20,000. You probably depreciated it all in the first year. So now its basis for IRS purposes is sitting at $20,000, or sorry, $0. When you go to sell that, there is going to be a gain there. And it's not just going to be capital gain. It's going to be an ordinary gain, which means it's subject to the ordinary income rates, which are 37%, 35, and 32, on and on and on. So that's difficult. So as a buyer and a seller, you're coming at this from two interesting perspectives. The buyer says, I want to buy assets because I want to depreciate them. And you say, well, if I'm selling you assets, then I'm probably going to have to pay ordinary income on that. I might have to pay 37% on some of that. And so they're two conflicting positions, but they can be okay, to the extent you're able to take that knowledge and use that as a negotiation tool, right? It's okay if you're paying more in tax, if you're able to bump that price up a little bit, right? So anyway, just some food for thought on that. With respect to stock, the good thing about selling stock is that stock is what we would consider to be a capital gain or a capital loss transaction. So when you're selling stock, you are able to take advantage of the favorable capital gains tax rates. So that's good. And those rates typically land at 15%, sometimes can be higher at 20, but 20 is very different than 37. And so again, when we think about the sale of a business, it's a very big transaction. It's something you've been building towards for many years, likely, or something you put your blood, sweat, and tears into for many years. So you don't want to make a rash decision. And I'm not advocating one way or the other on this. I think the circumstances definitely depend on your needs and based on the phase of your life. But I'm merely saying that as you go into this type of a scenario, it would be best to be able to understand, okay, what are the implications? What does this mean to me? How much tax can I expect to pay? And if the deal hasn't closed, how do I take this knowledge and utilize it to negotiate as favorable of terms to me as possible, while also, again, extending fairness and support us as to the new buyer. So just a couple of things to consider on that. Again, a couple other little things here. One option that most folks have is they will try to extend the sale over the course of a couple of years. If you're able to extend a sale over the course of a couple of years, that just means that you defer the payment of tax over the course of those years. It's good because the tax is able to go down. It's bad from the perspective of if you extend the sale over 2 or 3 years, the sale hasn't fully closed, you haven't gotten fully paid, and that leaves some risk. And that may be risk that you're not comfortable with, just to reduce tax. So again, nothing you should do one way or the other, just merely a consideration. The IRS uses their language and calls this an installment sale. It's when you sell a business or sell a piece of property, but don't collect the full amount in year one. You might collect it in year 2 or year 3 or year 4. And so again, it's a way they can reduce tax, but it also does create some additional risk for you, because if your buyer decides they don't want a full pay, they don't have sufficient collateral, then you're left empty-handed. So, and then again, lastly, be mindful of estimated tax payments. If you do sell a business and you've got a large windfall, you do need to put some of that money towards your federal and state estimated tax payments, so that you're covered there. Okay, so we're going to talk about entity structure here, and then we'll roll through a couple of other things here, because I know time is tight. The one thing that people talk about so much within the franchise community is they talk about S corporations. They say, should I be an S corporation? Should I not be an S corporation? And the answer is, again, it depends. Sometimes it can create a lot of tax savings for you. Sometimes it doesn't. Really what people are trying to do with an S corporation, generally speaking, is they've got an operating business that is making money. And what they want to do is reduce their payroll taxes, because when you're a sole proprietor and you're making good money, you're paying Social Security up to $147,000, and then you're paying Medicare on everything. And so can be a large tax bill. So if you become an S corporation, there's ways to save that. And usually, as you can see here in the slide, usually the tax savings range between $7,000 to about $14,000, $15,000. Again, it just kind of depends on your scenarios. But I do want to say this: an S corporation is not for everybody. If you're getting significant losses in your business because you've had a couple of bad years, I would not elect to become an S corporation. Those losses have the potential to be suspended and not even utilized on your personal return. So again, imagine a scenario where your S corporation has losses that you can't take, but you still have wages from your S corporation that you have to pay tax on. That's not what you want. You want to be able to match losses with income. So that's not a good scenario to be in. So again, if you're thinking about this, now is a good time to think about it. Typically, the IRS says if you want to be an S corporation for the current year, you need to tell us and make the formal election within 2.5 months of whatever you want your start date to be. So as an example, if you want your start date to be an S corporation to be January 1st, 2024, you need to let them know, and you need to get them to acknowledge your S corporation election by March 15th of 2024. So again, you can go out a little bit and go backwards, but that's the typical nature of this. So again, some people become very disappointed when they feel like they weren't even aware that an S corporation was an option. And so my thought would be, if you're not an S corporation, there might be a good reason for that. If you're considering being an S corporation, then let's have that discussion and see if that would be something that would be of value to you. And there's other types of organizations you can be, or other types of entities you can be as well, of course. Sometimes you can't be. Sometimes you really cannot be an S corporation. You may not meet the requirements. For example, you can't be an S corporation if you have more than 100 shareholders. So there's a couple of scenarios where you just cannot be one. You may have to default and be a partnership. Please be aware of this. Please be aware of the work opportunity tax credit. Please be aware of the FICA tip credit. These are significant credits out there that, if you're not taking advantage of, it's worth pursuing to see if you can. These credits can be sizable depending on the size of your organization. It can really make an impact on the tax returns. Again, because we're a little bit short on time, I'm just gonna mention that. But those are two big restaurant credits that are designed to benefit restaurant owners. And if they're not being taken advantage of, we'd love to talk about how that can be taken advantage of. Okay, I wanted to talk about the retention tax credit here very briefly. So many of you have received retention tax credits. And as you know, over the past 3 or 4 months, the industry for this has just exponentially grown. You've probably gotten dozens and dozens of calls from people saying, hey, have you claimed your credits? Hey, we can get you $26,000 per employee. Hey, have you done this? Hey, have you done that? And it was honestly becoming so robust that the IRS essentially put a moratorium on the processing of retention tax credit claims. So right at this very second, they're really not processing any claims. They've said, give us until January 1st and we will revisit it. My expectation is that they will revisit it and do this, but they are just going to put some additional safeguards around it so that they can do what they can to police this just a little bit better. So with that being said, if your retention credit has not processed fully, it's likely just in the queue. If you still haven't submitted all of your retention credit forms, there still is the opportunity to do that. And I would recommend being first in the line when the IRS opens this back up. So again, if that's a conversation that you haven't had with a professional yet, we'd love to talk with you about that because we do provide that service. But I don't want the IRS's moratorium to scare anybody either. Folks in the restaurant industry were hit, I could argue, the hardest, and they have the most legitimate claims, despite the fact that there's many others in the economy that have illegitimate claims and are really looking for a money grab. Generally speaking, in the restaurant industry, you obviously dealt with the closures, dealt with the distancing, dealt with the mandatory shutdowns. So there's a very good case for the restaurant owners. Again, your circumstances will depend on your state and your circumstances, but you shouldn't let this be something that scares you away from refunds that you may be entitled to. So if that's something that you're not sure about, we'd love to talk about that. The other thing I will mention is this. If you have received the retention credit refunds, those refunds do have to be included as a reduction of wages on your tax return. They do have to be included there. So if you have not, if you've not done that, then that does need to be done. And I would 100% advise that you do that. So they do need to be included, and that's something you don't want to wait on if you've received your full refund. So again, we'd be happy to talk about that offline, but just be aware of that. Retirement plan contributions are always a good thing to do. Even if you have a simple legal structure, you can always do an IRA. You can always, put money away and consider that. One of the things that sole proprietors often do is they decide they're going to involve their kids in the business, pay their kids a little bit of money. And even if their kids are 14, 15, and 16, pay their kids a little bit of money and then turn around and have those kids contribute that money they earned to an IRA. So from a business owner perspective, what you've done is you've basically said, okay, I get a deduction for employing my kid. And then my kid, because the income is so low, typically if you're 14 or 15, they're not going to pay any tax on it or very minimal tax. And then they take that earned income and turn it into an IRA. And all of a sudden you've started a financial planning future for your children. And, they got to work, they got to earn money, they got to invest it, and you're setting them up for a very, very safe path financially. So again, there's plenty of things to talk about with this, whether you're in the mode of doing IRAs, whether you're in the mode of doing a 401k, if you want to try to do something a little more sophisticated that involves profit sharing. If you've got significant income and you want to look to the future about how you'll retire, this is a great opportunity to consider that. So with that being said, we're going to conclude here. I do have two other poll questions that we want to just send through here. One of them is most important, if you're willing to fill it out. So I'm going to have our host go ahead and post those real quick here, and then we will formally conclude. All right, if you're willing to fill this out, how many restaurants do you currently manage or own? Just to help us to get a feel for the number and the quantities and all of that. And then we've got one more poll question that will show that would you be interested in a follow-up webinar covering any advanced topics? So, we feel connected to the Denny's community. We would love to be able to provide whatever information is useful, whether you decide to use our services or use other services. We want to make sure that information is out there and that the franchisees are taking advantage of everything as it relates to tax planning, as it relates to key performance indicators for your business, as it relates to maximizing the key performance indicators, et cetera. We want to be available for that. And so if there's anything that you feel like would be especially important, feel free to reach out and we'd love to have that. So with that being said, what we're going to do is we're going to formally conclude. If you have any additional questions, you're welcome to reach out. Each of you should have my email, and it was in the Denny's franchisee newsletter that just came out. And you're welcome to email, and or if you feel like picking up the phone and calling, we like to talk on the phone too. But I appreciate everyone's attendance. It was great to have you. And like I said, this was designed to be an appetizer so that you could really see, okay, what things could be applicable to me, but I recommend that you speak with your tax advisor or you reach out to us if you're interested in considering some full tax planning to see if these specific solutions could be excellent for you. So thank you again for your time and have a great rest of your day.